The main achievements of EPRA during the last 2 years have been numerous. What springs to mind firstly is the way in which the companies have aggregated their IR programs. We did that by the formation at the beginning of my chairmanship of an IR committee, and that has brought together all the best-in-class skills we've got from all the different companies, putting their heads together and thinking how we take EPRA and the sector forward as a whole, again to ensure that the relevance is absolutely maximised. So that's been key.
Put simply, the mandate for the EPRA UK and Investor Outreach programme is to engage with the largest organisations, being pension schemes, investment managers and consultants throughout the UK and the Nordics. In terms of institutional AUM, the EPRA resource suggests pension scheme assets in the order of €3 trillion and investment management assets of some €7 trillion.
EPRA has held a number of meetings with different parties in China, institutions, pools of money and so on, to educate and inform them as to the size and scope of the listed real estate market in Europe. And that is an ongoing requirement. EPRA's end game must be to capture a slice of the institutional money that will come out of China and go into listed real estate. For the last 3 decades, China has been regarded as a manufacturing centre of the world, but in the next 1 or 2 decades, I think it's going to be a supplier of capital to the world.
The research being commissioned by EPRA, the Investment Property Forum, AREF and the Institute of Actuaries is looking at how defined contribution schemes work within the UK and also the role that real estate can play within those schemes as opposed to defined benefit schemes. One of the key reasons for commissioning this research was because of auto-enrolment in the UK, and this is expected to add another 6 to 10 million people to the pensions pot within defined contribution schemes. As a result, this is a very strong and growing market, and we need to look at how real estate plays a role within these schemes, which have a greater requirement for liquidity than within defined benefit schemes.
Estimates range anywhere between 100 and 150 billion pounds as we get into the 2030s. So although we won't necessarily stick at 20% of our portfolio invested in real estate, we expect our exposure to real assets to be around that level for the foreseeable future. And at the moment, the primary way into that is real estate.
There's a very good example of one product that's currently available for defined contribution schemes. This combines a direct property fund with a global REIT tracker in the proportions 70% to 30%.
The current split between listed and unlisted is 1/3 in listed and 2/3 in unlisted, and the listed portion is globally invested. When we think about the allocation between listed and unlisted real estate, we actually have a preference for unlisted because we want to be closer to the source of production. We actually think that gives us better governance. Having said that, listed gives us a number of positive attributes, obviously liquidity, but also we manage to get more global exposure, better diversification across different sectors. So listed has a very key role in our portfolio. We think that the listed industry should be focusing more on the long-term attributes, the fact that risk-adjusted returns in listed and unlisted are broadly similar, and clearly there are some positives that listed can provide which unlisted is unable to, particularly the ability to diversify relatively easily with low governance costs.